In this video, we're going to talk about using moving averages as a stop loss. Stay tuned. Hey traders, a very warm welcome to you. Okay, so moving average is pretty useful for aligning yourself with the trend. We know we can use them as entry criteria, we can use them as exit criteria. Pretty handy way of looking at a price chart and getting an average over a certain period of time without having to look at all the noise that goes on in between that. However, can we use moving averages as a stop loss? Yes, we can. Here are some ways. So the first one we can do is when price touches or crosses a moving average. So consider this. You have a chart here and you're going long. Your stop is going to be at a moving average position. The moving average may well be below. Let's use the red one here. It's coming here. You've got a fixed area for your moving average. You already know what it's going to be. But by the very nature of a moving average, it's a trailing stop loss. It's going to move in the direction of your price. Now, not always. Sometimes the price may extend. The moving average might start turning as price is coming down to it. But generally speaking, we've got this initial stop loss criteria here, whatever that may be. Let's say that's 50 pips if we're trading on currencies. And as price starts to move in our direction, whatever moving average we're choosing is going to catch up with price, but it's not going to be, extra aggressive with it. Let's change it to green now, so we're not confusing ourselves with that line. It's just going to follow price up, and eventually, let's say price is kind of chugging along up here. Eventually it's going to come down and it's going to tag a moving average and you're going to be out. So not only does it give you your initial stop loss, you don't have to worry about kind of placing it under a key level or finding a good position for it. You can just eyeball a chart and you can say, hey, how many times have we touched this moving average in this trend that I'm trying to capture? Very few. All right, I'm going to use this now as a tool to navigate the noise in the market. I'm going to say this is my stop, and literally you start off with that and you drag it up and up and up and up. So not only has it got an initial stop criteria, it saves you having to look at charts and over analyze things. It's just there straight away, distance between price and moving average. But you've also got a trailing moving average as well, allowing you to take advantage of price spikes, allowing you to just leave it and let it run out and not think about too much things. And there's something to be said, guys, about keeping things simple. Is this effective in the right market conditions? Yes, it is. In the wrong market conditions, no, it's not. You're going to get stopped out constantly. You're going to have to use a much more complicated strategy in terms of dragging your stop loss up. But is this a broad way of looking at things that can work very well? Yes, it is. Look at number 2, price closes above or below. So rather than just that intraday kiss that we often get with price, it might come down, that might be an intraday kind of tail, then we carry up and we close here. You're just giving yourself a little bit more room to breathe. The disadvantage of that, of course, is that you're going to give up a little bit more slippage. Price may cross here and then may close down here, giving you an extra 20 pips slippage or whatever it may be. Or you could have a scenario where the positive side of it comes down, then intraday comes back up and keeps you in the game. That's the decision for you to make, a commercial decision for your trading business. Do I want to give it a little bit more leeway for the potential to be stopped out less frequently, but when I do get stopped out, I could get some slippage? Again, it's going to be up to you just eyeballing the chart, the trade, the market environment you're in, the conditions, what's coming up, and making the decision based on that. There's no real right or wrong definitive answer to that one. So we've got the price crosses or price touches, price closes, open. Price closes above or below. Obviously, it depends if you're going long or short. If it's short, then it's going to be above. If it's long, it's going to be below. Okay, the fast crosses the slow. There's a little bit of variation on this. I'm not sure how I like this. This is kind of the standard moving average exit strategy that we'd have if we were trading moving average crossover strategy. So the fast crosses the slow, we get in. The fast then crosses the slow the other way, we get out. We can use that as a stop. Now, again, this is the kind of thing that does work and can work if we're using it in the right market conditions. I'm kind of stressing that because it's so important that we're in a trending environment. Otherwise, you are just going to get crosses and crosses, constant crosses, and you're going to be so late when by the time moving average does cross, you're just going to be losing money. So, coming back to the point of just looking at the chart you've got in front of you, not overcomplicating things and saying, hey, What's the chart saying? How many times have we tested this moving average? Which is the best moving average that fits into the conditions I've got now? Yes, people say, oh, you're curve fitting and what have you. No, we're just trading the environment we've got in front of us at the moment in time. If price is bouncing off the 20 period daily moving average, then let's use a 20 period daily moving average to frame our trade. If price is same as we're trading in within a channel, we just use the channel until it doesn't work anymore. We don't have to be ultra clever by this and try and predict anything. We just see what it's adhering to and trade with that. There are times when we have really extreme momentum and the 5 period daily is hugging price, but it just keeps going because it's extreme momentum, extreme supply demand shifting, and 5's pushing up. Sometimes it's going to be so range bound we have to use a 50 or even a 100 period because it's in the wrong kind of environment. I wouldn't go that far because you're kind of not really in a trend then. You want to have a reasonably steep trend. So 20 period, 10 period, 5, a good gauge and a way to get involved in this. And the final thing here, I don't know why I've put 3 twice, is obviously number 4, is X closes above or below. This is, what I mean by X is a specific number of closes. So you're giving yourself a little bit more room to breathe based on history. So you might say, you know what, very often in this trend, we've had a couple of candles that have just kissed under that moving average and then we've resumed the trend. So I'm going to allow for that. And I'm going to say, hey, if we have 3 closes below, I'm out on the 3rd close, or 1 close below, I'm out on the 2nd, or whatever it may be. It's just giving yourself that flexibility, again, whether you say touch, a close, or several closes, you're widening out the stop, but of course you're allowing for noise. We'll come back to the initial point of just look at the chart you're trading. Is it very noisy? Is it very wicks everywhere? Do we have kind of extreme moves that reverse? How can you capitalize on that from an entry perspective? And how do you not get hammered by that from an exit perspective? There's no point having a very tight stop loss strategy if historically prices very often spiked in one direction and spiked back. You want to protect yourself against a prolonged spike as opposed to that initial spike. And many people make the mistake, and myself included, sometimes you try and press what you want onto the market. And the market doesn't care. We've mentioned this many times before. You hear it in trading books. It just doesn't really care. You want to use a specific strategy. If it just obviously has been stopping people out by using that strategy, don't use it. Look to refine it and tweak it and adjust it. Yes, your position size may have to be smaller because you're accommodating more noise. Your stop is larger, but the payoff is you stay in for the longer moves. So hopefully that's what you're kind of looking for. Other permutations of this, take out some of the trade on the first tag of the moving average. Maybe you have several moving averages of 10, 20, 25, 30, something like that, or less or few or more, and you scale out of the position as it tags those. Or there's just unlimited ways of doing it. But the point is, when using moving averages as stop loss, it's simple. You don't have to think about it. You can just say, that's the way I'm doing it. We're in the right conditions for it. I'm using, I think, the right moving average. I know where my exit's going to be. And the one thing as well, finally, guys, is psychologically, you can, when you're in the cruise, as I call it, i.e. you've got the trade going, it's running in your direction, you're very happy with it, you can always say to yourself, hey, basically my running P&L, instead of reading the running P&L from here, if you must read your running P&L saying, oh, you know what, great, that's £2,000 or whatever it may be, and feeling that that's what you've got, you look at your running P&L from the moving average. So then you say, actually, it's £1,700. All right, so it reframes it, so you're not going to lose. You don't feel like you're losing money from the high. So psychologically, it's easier to base. So, okay, 17, 18, 19, and even though this may be shooting up, you're still anchoring your exit to that moving average if you're using this as a stop loss, which is not a bad strategy to do. Helps you kind of not feel bad about getting involved in giving stuff back. And just sort of reframes things mentally if that's something you struggle with. If you struggle with kind of your whole portfolio having a high watermark of X, seeing a lot of it coming back and being frustrated by that, when in reality that's just your exit criteria, then you can reframe and just kind of plot your mark-to-market P&L based on the moving average as opposed to current price. Not saying you're not going to get some slippage or something if that comes down, but it's better framing it that way than it is the high point of the trade. All right, guys. Give it a thumbs up if you like this kind of stuff. See you in the next one. Take care. Bye-bye.